Let me run some numbers for you quickly. We'll say we have a $1 million business. As a buyer, I'm looking at similar businesses in the same industry, $1 million, but that isn't what it costs the buyer to buy your business. Because traditionally, if you follow the traditional model, it's an all after-tax event. Which means as a buyer, what's the opportunity price? I have to have $1,750,000 in gross earnings to pay tax of $750,000 to give the buyer $1 million. Next year, that's going to increase because of tax rates. And then as a seller, I've got a couple $100,000 tax liability due. So right now, we've paid $1 million in tax to transfer a $1 million business to a seller. That's horribly inefficient. And as a buyer, I'm going to say, you know what, everything I'm looking at now is $1,780,000, $8 million, you know. All of a sudden, what we do is I create strategies that say, as a buyer, Mr. Buyer, here's what we're going to do. We can turn your opportunity price from $1,750,000 down to $1,350,000. Wait a minute. That's $350,000, $300,000 tax savings. That's more than I was asking the buyer to take a discount for me to buy the business. Because without that strategy, seller's got to discount it a couple $100,000 to sell the business because he's looking at 5 opportunities for $1 million. And if you want to sell your business, you're not going to sell it for $1 million because he's got 5 other offers out there like that. So you're going to have to sell your business for less than what you want. But if we explain to the buyer that the opportunity price is $1,750,000 and we can drop it down to $1,350,000, save him $300,000, $400,000, we just gave him more of a tax deduction, tax savings, than had you had to discount your business. So sellers will walk away with their full sales price. The savings for the buyer is paid for with tax savings, more than what he would have gotten from the seller had he requested or required a reduction in price. And we have a win-win situation.